How to develop a backtested trading strategy for consistent profits. In the world of trading, whether it's stocks, Forex, cryptocurrencies, or commodities, the ultimate goal is to achieve consistent profits. However, the path to profitability is often riddled with challenges, including market volatility, emotional decision-making, and unpredictable events. One of the most effective ways to navigate these challenges is by developing a backtested trading strategy. A backtested strategy allows you to evaluate the effectiveness of your trading ideas using historical data, giving you the confidence to execute trades in real time. In this video, we'll explore the step-by-step process of developing a backtested trading strategy for consistent profits. 1. Understand the basics of trading strategies. Before diving into backtesting, it's essential to understand what a trading strategy is. A trading strategy is a set of rules and criteria that guide your trading decisions. These rules can be based on technical indicators, fundamental analysis, or a combination of both. The goal of a trading strategy is to remove emotion from the decision-making process and provide a structured approach to entering and exiting trades. There are several types of trading strategies, including trend-following strategies. These strategies aim to capitalize on market trends by buying during uptrends and selling during downtrends. Mean reversion strategies. These strategies assume that prices will revert to their mean or average value after deviating from it. Breakout strategies. These strategies focus on entering trades when the price breaks through a significant level of support or resistance. Scalping strategies. These strategies involve making multiple trades throughout the day to capture small price movements. Understanding the type of strategy you want to develop is the first step in creating a backtested trading strategy. 2. Define your trading goals and risk tolerance. Before developing a strategy, you need to define your trading goals and risk tolerance. Ask yourself the following questions. What is your target return on investment, ROI? How much risk are you willing to take on each trade? What is your time horizon for holding trades, e.g., day trading, swing trading, or long-term investing? What markets or assets do you want to trade? Your answers to these questions will help you tailor your trading strategy to your specific needs and preferences. For example, if you have a low risk tolerance, you may want to focus on strategies that prioritize capital preservation over high returns. 3. Choose your trading tools and platform. To develop and backtest a trading strategy, you'll need access to the right tools and platforms. Some popular trading platforms that offer backtesting capabilities include MetaTrader 4/5, a widely used platform for Forex and CFD trading. TradingView, a web-based platform that offers charting tools and backtesting capabilities. Python, a programming language that allows you to create custom backtesting scripts using libraries like Pandas, NumPy, and Backtrader. QuantConnect, a cloud-based platform for algorithmic trading and backtesting. Choose a platform that aligns with your technical skills and trading goals. If you're comfortable with coding, platforms like Python and QuantConnect offer more flexibility. If you prefer a user-friendly interface, platforms like TradingView and MetaTrader may be more suitable. 4. Develop your trading strategy. Once you've chosen your platform, it's time to develop your trading strategy. Start by identifying the key components of your strategy, including entry criteria. What conditions must be met for you to enter a trade? For example, you might enter a trade when a moving average crossover occurs or when the relative strength index, RSI, indicates an oversold condition. Exit criteria. When will you exit a trade? This could be based on a profit target, a stop-loss level, or a trailing stop. Position sizing. How much capital will you allocate to each trade? Position sizing is crucial for managing risk and ensuring that no single trade can significantly impact your overall portfolio. Risk management. What measures will you take to protect your capital? This could include setting stop-loss orders, diversifying your trades, or limiting your exposure to a single asset. Write down your strategy in clear, unambiguous terms. This will make it easier to translate your strategy into code or rules for backtesting. 5. Backtest your strategy. Backtesting is the process of testing your trading strategy on historical data to see how it would have performed in the past. The goal of backtesting is to evaluate the effectiveness of your strategy and identify any potential weaknesses. Here's how to backtest your strategy. Gather historical data. Obtain historical price data for the asset or market you want to trade. Ensure that the data is accurate and includes all relevant information, such as open, high, low, close, and volume. Set up your backtesting environment. Use your chosen platform to input your trading rules and criteria. If you're using a programming language like Python, you'll need to write a script that simulates your trades based on historical data. Run the backtest. Execute your backtest and analyze the results. Pay attention to key performance metrics, such as profitability. Did your strategy generate a positive return? Win rate. What percentage of your trades were profitable? Risk-adjusted return. How much risk did you take on to achieve your returns? Metrics like the Sharpe ratio can help you evaluate this. Drawdown. What was the maximum loss your strategy experienced during the backtest period? Optimize your strategy. If your backtest results are unsatisfactory, consider tweaking your strategy. For example, you might adjust your entry and exit criteria or modify your position sizing rules. However, be cautious of over-optimization, which can lead to a strategy that performs well on historical data but poorly in real-world trading. 6. Forward test your strategy. Backtesting provides valuable insights, but it's not a guarantee of future performance. To further validate your strategy, consider forward testing it in a simulated or live trading environment. Forward testing involves applying your strategy to real-time market data without risking actual capital. Many trading platforms offer demo accounts that allow you to forward test your strategy. Use this opportunity to observe how your strategy performs under current market conditions and make any necessary adjustments. 7. Implement risk management techniques. Even the most well-designed trading strategy can fail if proper risk management techniques are not in place. Here are some key risk management principles to follow. Set stop-loss orders. A stop-loss order automatically exits a trade when the price reaches a predetermined level, limiting your losses. Diversify your portfolio. Avoid putting all your capital into a single trade or asset. Diversification can help reduce the impact of a losing trade. Limit leverage. While leverage can amplify your profits, it can also magnify your losses. Use leverage cautiously and only when necessary. Monitor your trades. Regularly review your trades to ensure they align with your strategy and risk tolerance. 8. Monitor and refine your strategy. The financial markets are constantly evolving, and what works today may not work tomorrow. To maintain consistent profits, it's essential to monitor and refine your trading strategy over time. Keep an eye on market trends, economic events, and changes in market sentiment that could impact your strategy. Additionally, continue to backtest and forward test your strategy periodically to ensure it remains effective. Be open to making adjustments as needed, but avoid making impulsive changes based on short-term results. 9. Stay disciplined and patient. Developing a backtested trading strategy is only half the battle. The other half is executing your strategy with discipline and patience. Stick to your trading rules, even when emotions are running high. Avoid the temptation to deviate from your strategy based on fear or greed. Remember that consistent profits are the result of long-term adherence to a proven strategy, not short-term gains from risky trades. 10. Learn from your mistakes. No trading strategy is perfect, and losses are an inevitable part of trading. Instead of viewing losses as failures, treat them as learning opportunities. Analyze your losing trades to identify any mistakes or weaknesses in your strategy. Use this knowledge to refine your approach and improve your future performance. Developing a backtested trading strategy for consistent profits is a systematic process that requires careful planning, testing, and execution. By following the steps outlined in this video, you can create a strategy that aligns with your trading goals and risk tolerance. Remember that success in trading is not about making quick profits but about building a sustainable and disciplined approach to the markets. With the right mindset and tools, you can achieve consistent profits and long-term success in your trading journey. Like, subscribe, and hit the notification bell for more trading insights. Share your thoughts in the comments. Have you tried backtesting your strategy?